Hello everyone and a very warm welcome to this ICAS webinar, our Spring Tax Update Part 1. For those that don't know me, my name is David Mingus. I'm Director of Practice here at ICAS and it's my great pleasure to be hosting this webinar today. Well, of course, our Spring Tax Update series is one of the most popular and highly recommended member technical updates that we provide at ICAS. And while it's time to allow us to look at all the announcements in the recent budget delivered by the UK government, the actual substance of the spring budget announcements from the Chancellor Jeremy Hunt were perhaps rather limited when taken against what was potentially the last major fiscal event before the next general election. However, despite that, there is an awful lot still going on in developments which affect tax practitioners and general practitioners alike, and of course those in business and industry. So we certainly don't have a shortage of content to share with you over this two-part tax update webinar series. In this, the first of the spring tax updates, we're going to be concentrating on updates which impact on owner-managed businesses, employment taxes and devolved taxes. So what were the announcements in the Chancellor's statement and buried deep in the underlying budget documents? What are the key tax policies and developments for OMB and employment taxes, and what are the key difficulties for businesses, employers and practitioners that you need to be on the lookout for? Well, to help explain and help us understand some of these matters, I'm delighted today to be joined by Justin Ricamini, who is Head of Tax for Employment and Devolved Taxes at ICAS. Justine represents ICAS at several HMRC and industry forums, including HMRC's Employment and Payroll Group, the Employment Status and Intermediaries Forum, and the Construction Forum, and is a member of the Scottish Tax Policy Forum, which is a collaboration between ICAS and the Chartered Institute of Taxation. We are also joined today by Chris Campbell, who's Head of Tax for Tax Practice and OMB Taxes here at ICAS. Chris is a Chartered Accountant and Chartered Tax Advisor and joined ICAS after a career in practice supporting owner-managed businesses. He supports members with various technical queries and represents ICAS on various HMRC stakeholder groups. So it's a great pleasure to have both Justine and Chris with us today. But before I hand over to both of them, just a few housekeeping matters just to remind you of. You can, of course, submit questions at any time through the Q&A facility, which is accessible at the top of your screen. Questions can be submitted anonymously, and we'll be saving you all your questions until the end of the webinar for the live Q&A section. You can also join the conversation today with everyone else on the webinar through the chat box, which is also accessed at the top of your screen. And this allows you to comment or discuss with fellow attendees the matters covered by the webinar. We are, of course, recording the webinar and will make it available for on-demand viewing afterwards in case you want to refer back to it or share with others. And common question, yes, the slides will be available and those will be available on the events page on the ICAS website under the events listing shortly after the conclusion of this webinar. So we do look forward to receiving your questions throughout the course of the webinar, and of course we'll try to get to as many of those as possible. But I know Chris and Justine have an awful lot of content to get through, so without further ado, I'll just pass straight across to Chris to kick things off. Chris, over to you.
Thank you very much, David. Good morning, everyone. Hope you're all well, and it's great to be with you this morning. Just a little bit of an overview, first of all, on our topics for today. First of all, I will cover the key points on the owner-managed business front following the spring budget. I'll then pass over to Justine, who will cover the devolved taxes update for both the Scottish and Welsh budgets, followed by an employment taxes update before passing back to myself, where I'll cover off the latest developments in making tax digital and a few other topical issues that you might want to be thinking about in the coming weeks and months. There will, as David said, be an opportunity for some questions and answer session at the end. So starting off with the spring budget, I thought it would be easiest to look at what's not changed, because there's some things that have changed. So lots of things that have been static over the last few fiscal events. The personal allowance, it's remaining at 12,570 through to April 2028. The UK income tax rates, now that will affect Scottish taxpayers insofar as capital gains rates are concerned and dividend and interest income, but Justine will go on and talk about what the Scottish rates are. But no change to the UK rates. But the dividend allowance, that's going to be reducing to £500 from the 6th of April. The National Insurance upper earnings limit, that remains aligned with the UK higher earnings threshold, which can have an impact on the marginal rates for Scottish taxpayers. And I know that we spoke a little bit about that in some of our commentary in the Scottish budget just before Christmas. No changes in corporation tax rates. They're staying at 25% and 19%, and the inheritance tax nil rate band is still frozen until April 2028, although there was an announcement on inheritance tax that I'll talk about very briefly. And lastly, on the what's not changed, the capital gains tax annual exemption, that's going to be reducing down to £3,000. And I think it's important to remember how much that's came down and the impact that that might have on taxpayers who were not previously in the scope of self-assessment, who will now be brought into self-assessment because their capital gains will no longer be covered by the annual exemption. So in terms of what has changed, the high income child benefit charge is probably one of the most significant announcements in the spring budget. We have been commenting on that in terms of the threshold remaining unchanged since it was introduced in January 2013. So the £50,000 threshold often been seen as a little bit unfair in some respects, because you could have one household with one earner having an income of £60,000 receiving no child benefit, and two households receiving just under £50,000 each, being able to claim their full child benefit without any restriction. So there's been a lot of pressure on the Chancellor to do something about this, and he has listened to that in terms of the threshold. He's increased the threshold from £50,000 to £60,000 from April 2024. And he's also changed the taper rate. So that's the rate after once income goes above the £60,000 at which the child benefit is withdrawn through the HICBIC charge. Now that will mean that child benefit will only be completely withdrawn once one earner in the household receiving child benefit exceeds £80,000. So that's probably going to mean for the next couple of years, at the very least, there might be some clients that you're working with who previously were well above the threshold for HICBIC. They might have elected not to receive their child benefit payments. They might want to look to revisit that. It's important to bear in mind that the earlier, if they are wanting to revisit and make a child benefit claim, the earlier that's done, the better, because it's only possible to backdate the child benefit claim by a few months. The Chancellor did, however, announce that in response to the request for making the system fairer, that there will be a move to a household system from April 2026. That, of course, is after the next UK general election, whenever that will be. So whether that will actually come to pass might depend on what the outcome of the election is. But certainly at the moment, there's a plan to move to a household system from April 2026. We don't have any details on that. There's going to be a consultation, and it's going to be something that we will be feeding back to HMRC very, very closely on. We're quite mindful of the fact that it's important to respect the principle of independent taxation. We think it's really important that that is preserved and that nothing that happens with the HICBIC system going forward compromises that in any way. So we'll watch that very, very closely. Just mentioning very, very briefly at the last point in the slide, the National Insurance Credit for Child Benefit Claimants. Now, there are some articles that we've published on high income child benefit charge over the last few months on icas.com. One of those is in respect of the ability to, I think it's actually from April 2026 when the household system changes, to go back, and if someone hasn't claimed child benefit because of HICBIC being an issue, if they've just not claimed rather than elect not to receive the payments, they wouldn't currently have a national insurance credit, but there is going to be the option to make up for any previous years where there might be a shortfall in someone's state pension entitlement, for example. But that is something just to bear in mind and keep an eye on. But I always would still suggest that although it's maybe a little bit more complicated, it's better to claim child benefit and elect not to receive it if you think you've got someone who's affected by HICBIC and doesn't want to be paying the tax charge. And by doing it that way, if circumstances change, it's possible to reinstate the child benefit claim and also make sure that national insurance credits are claimed as we go. Another announcement in the spring budget was on furnished holiday lettings. Now, there are lots of advantages of FHL treatment, the ability to claim capital allowances on any furniture and equipment that's used in the property, capital gains tax reliefs, whether that's business asset disposal relief, holdover relief, rollover relief. FHL properties are also treated as earnings for pension purposes, and they're not part of the restriction on finance costs when it comes to the any interest costs. So there's not the restriction that other residential income would have. The Chancellor is mindful of the fact that this creates a tax difference between those properties that are let out in short-term lengths and those properties that are let out on longer-term, more traditional rental arrangements. He's mindful of the fact that in some places that might mean that the property market is not open to longer-term tenants, and that's one possibility. I know there'll be lots of people who are listening to this webinar who may live in communities where the furnished holiday letting market is thriving, and this will be a big blow to those who are in that sector. So there'll be mixed views as to what the Chancellor has announced, but at the moment, as things stand, the spring budget has announced that FHL treatment will be abolished from April 2025. There's going to be some legislation coming out. We haven't seen the draft legislation as yet, but what we do know is that there's going to be an anti-forestalling rule so that any transactions on or after budget day are not going to benefit from the FHL treatment. That would be probably more on the capital gains tax side. And I have spoken to a number of people who have had clients with transactions that were maybe ongoing but not completed on budget day. So they may be unable to qualify for capital gains tax relief, for example, on the rollover relief if you sold one furnished holiday letting property or another qualifying asset and you were looking to roll that into a furnished holiday letting property. It's looking like that might not be possible because of the anti-forestalling rule, but until we see the detail, we can't be certain. The last point in FHL that I'll just mention very, very briefly is that it's important to bear in mind that companies can also have furnished holiday letting. It's been branded in the budget as being a personal tax issue, but there are this in there in the Corporation Tax Act 2009 that FHL costs as a trade. So what we're at this point unclear on is what happens if you've got a company who which has been carrying out letting income through furnished holiday lettings. How will that work if it came to the disposal of the shares in that company, for example, or on another aspect? So until we see the actual legislation, we don't actually know how it will impact, if at all. On the other side of capital gains tax, we've got the change in the fact that furnished holiday lettings might no longer benefit from the 10% business asset disposal relief. The capital gains tax rate for all residential property is reducing from 28% to 24% from the 6th of April. There's not going to be any change to the basic rate, 18% capital gains tax rate, but the higher capital gains tax rate. So it could be that some of those who are going to pay more capital gains tax in the furnished holiday lettings won't pay as much as they would have been had this rate reduction not been. But for those who are disposing of properties that are not their principal private residence, but are going to have capital gains tax at the higher rate, they are not going to pay as much. Now, I have spoken to someone who has said that they had a client who's just completed a non-furnished holiday lettings transaction who wishes that they hadn't done so because they would perhaps pay less capital gains tax in the next tax year, 24-25. The annual capital gains tax annual exemption is, however, reducing. So for those transactions, it's very, very difficult to progress a transaction, certainly at this stage in the tax year, to delay it from one tax year to the next. For some people, it will be better in this tax year. Some people will be better in the next tax year. And that's just always the nature of these things when it comes to tax. The key thing, of course, is the timing of the disposal is really, really important. And that's based on when the contract for sale is unconditionally included. So if that contract for sale is unconditionally concluded in the current tax year, it doesn't matter if completion doesn't take place until after the 6th of April. It will be reported on the current tax year, and it would be, so if it was furnished holiday lettings before budget day, that would be fair enough. Or looking at any other transactions at either 18% for basic rate or 28% this side of 5th April, and from 6th April, 24% for the higher rate going forward. Very, very briefly on the national insurance front, this was a key point in the autumn statement. Not a huge amount of change in the Class 2 front in the spring budget. There's a removal of the requirement to pay Class 2 national insurance. The Chancellor is looking to try and abolish that completely. And there is, however, if you've got someone who's earning below the small profits threshold, there's an ability to make a Class 2 voluntary contribution at £3.45 per week for the 24-5 tax year. The bigger news on the national insurance front is on the Class 4. So when we had the last tax update just before Christmas, we were looking at Class 4 going from 9% to 8% from the 6th of April. That's all changed, and it's now going to 6% instead. But there's no change to the 2% rate on profits above the upper earnings limit. And I know that Justine will be talking about national insurance on the employment taxes side a little later on. On the capital allowances front, we've got full expensing. As we mentioned on the last update, the Chancellor announced that that will apply permanently. Now, permanently is only as much as the lifetime of the new government, so the current government. So if a new government came in and wanted to change things, it's only as permanent as the current Chancellor says it is. But it's there. It's expenditure on new and unused plant and machinery by companies. It's not available currently on leased assets or cars, but the spring budget did announce that the government is looking to extend, to some extent, details still to follow, of the availability of full expensing on leased assets. I'm just going to say very, very briefly about double cab pickups, because I know that Justine's going to be mentioning that for the employment taxes side. Those of you will know that those who've been monitoring things closely will know that there was a plan to change the treatment of double cab pickups for capital allowances so that it would be classed as cars. And then after a lot of reaction in the media and from various stakeholder groups in the agricultural sector, ICAS and other professional bodies and others, there was a very, very quick U-turn. So it's very much a case of as we are on that front. But I'll not talk too much about double cabs because I know that Justine's going to be speaking about that later on. Lastly, on full expensing, there's been some recent HMRC guidance on the availability of full expensing for partnerships where a company is a member. Now, normally people might think, oh, the fact that it's a partnership means that it can't qualify for full expensing because it needs to be expenditure by companies. However, HMRC has looked at the legislation which talks about the corporation tax rules applying where you've got a company as a member of a partnership. And that will mean that if you've got a mixed partnership or a partnership that's only comprised of companies as partners, then those you need to do two separate calculations, one for income tax for the individual partners if there are any, and one for corporation tax in respect of the company partners. And it should be possible to claim full expensing when it comes to the company aspect. Now, if it's not new and unused plant and machinery, you won't be able to claim full expensing, and a partnership that is not comprised entirely of individuals is not able to claim the annual investment allowance. So very much a case of looking at the conditions, what's the expenditure for, how much does it relate in the case of a partnership to a company. But there is an article on icas.com that looks at some of those issues in some more detail if you need to look at it. On annual investment allowance itself, there's no changes to the £1 million annual limit. I've put the picture that I've put on my last few presentations of what £1 million in cash looks like, because I've never seen it in real life. And it's important to remember that the AIA limit is not affected by any new and unused assets, so it potentially might be an option for companies if full expensing isn't available. Unincorporated businesses can't claim full expensing, with the exception of partnerships that we spoke about a few moments ago. But if you're looking at a company, I think it's worth thinking about. Now we've got used to full expensing being in alongside AIA. That's part of the permanent, or as permanent as it can be, framework for the capital allowances system. I think it's worth thinking, well, actually, is there a way to sort of maximise the capital allowances that can be claimed, and with thinking about the longer term view? And the reason for that is that there are some things, as we said earlier, that you can't claim full expense on. So used plant can be AIA. So you would claim AIA on any used plant. You can't claim full expensing. It's better for any special rate pool additions for AIA to be claimed, because it's only 50% first year allowance on special rate full expensing. But in both cases, you're not allowed to claim AIA or full expensing on cars. So the first year allowance on cars that's separate for electric cars and very, very low emission cars. You might want to think about, beyond all that, you might want to think about, well, actually, if I've claimed some AIA on the used editions, claimed AIA on any special rate pool editions, and there's AIA left, it might actually be worth thinking about claiming AIA instead of full expensing, because if you have an asset on which full expensing is being claimed and it's in the main pool, that's 100% balancing charge, regardless of what the capital allowances pool is. 50% balancing charge for the special rate pool. But if you've got annual investment allowance and you've got a pool brought forward, you can take account of the capital allowances pool brought forward when deciding on calculating how much balancing charge would arise. So in some cases, if you've got a significant pool, it might actually reduce the balancing charge in the year of disposal of an asset. Everything's got to be looked at in the round. I merely flag it up as a potential planning opportunity to think about. Some people will have other things. If you're selling and buying at the same time, it may not necessarily make a bit of a difference. If you've got a small capital allowances pool, it's less of a consideration. But I just merely flag it up there to give some thought to. Inheritance tax, as I said earlier, no changes to the inheritance tax rates and bans were announced, but the spring budget did announce the extension of the scope of agricultural property relief for land managed under environmental agreements with UK government, devolved governments and other public bodies. This will apply to lifetime and death transfers on or after the 6th of April 25. But it will relate to environmental land management scheme arrangements that are either on budget day or after budget day or before budget day if they remained in place, so the 6th of March 2024. And this is something that ICAS has been calling for, because I think it's really, really important that there's not any disadvantage for a farming business taking part in an environmental land management scheme. And it's really good to see that happening in the case of inheritance tax. There are some other tax issues that are going to be looked at as part of a working group, and we look forward to hearing how that comes across in due course. HMRC has stated that it's going to be providing guidance on how you can demonstrate that land has been used for agricultural purposes before the change, because it's not intended to give relief for land that would not have otherwise qualified for APR. Very briefly on VAT, I'll not go into any real detail on this, because we did have a separate webinar just a couple of weeks ago on the 12th of March on this with Tony Cochran, but just to flag that the VAT registration threshold after many years of being at £85,000 is going up to £90,000 from the 1st of April 2024. The VAT deregistration threshold is also increasing from 83,000 up to 88,000 from the 1st of April. If you have any queries or anything that you want to look at on that, the recording is available on icast.com of that webinar. And if you need any support, then please do feel free to get in touch with us through the ICAS Technical Help Desk. I'm very, very pleased to be handing over to Justine, who's going to take us forward on the devolved taxes aspects. Over to you, Justine.
Thanks, Chris, and good morning to everyone. Yes, I'm just going to get on with it because I've got a fair bit to get through in a few short slides. So let's first of all talk about devolved taxes then. So we had the Scottish and Welsh budgets on the 19th of December. They were both delivered on the same day. One was delivered by way of a published document by the Welsh government, and the other one was done by Shona Robison, who is the Cabinet Secretary for Finance at the Scottish Parliament, as we know. So she actually stood up and did her speech in person. So the Welsh government had actually closed for Christmas by the time they delivered theirs. So it didn't really receive any press coverage whatsoever. Whereas there was quite a lot of a flurry of press interest in what the Scottish government had to say. So as we know, I've put a link, by the way, up there to the budget announcement itself if you actually want to read the detail. But the things that we know about that were real headline grabbers were the fact that there are now 6 rates and bands of income tax in Scotland for 2024-25. The introduction of the new advanced rate, which is 45% on earnings between 75,000 and 125,140. So the starter, basic, intermediate and higher rates remained the same, albeit the starter and basic rate thresholds were increased by inflation. And the higher rate threshold was frozen again at 43,662, which means that it is still £6,608 different to the UK higher rate threshold. So people start paying high rate tax, obviously, at an earlier stage in Scotland. And the top rate was also increased by a percentage point up to 48% from the 6th of April. So just in case you've never seen the world famous ICAS Ready Reckoner, which we produce after we've done after there's any rate changes in Scotland. It basically what happens is it's a comparator between UK and Scottish tax rates, and it shows a break-even point. And this time, the break-even point with the UK rates and bands is 28,867. So that's when people in Scotland and the rest of the UK pay the same amount of income tax. And it's interesting to note that the given the rise in national living wage, or national minimum wage as it's more popularly known, from the 1st of April 2024, the actual sort of national minimum wage earnings for a full-time equivalent person is around about £23,500 now. So that just kind of puts the 28,867 into focus. You don't really have to be on megabucks to be earning that amount of money. Below 28,867, you're £23 better off a year in Scotland. Above that, if we take £50,000 a year as an example, it starts to ramp up a little bit, and you are actually about £1,500 a year worse off in Scotland than you would be in the rest of the UK. So if you think about it in multiples of 50k, you get my drift. So suffice to say, really, without getting into the politics of tax rates, which ICAS doesn't want to do, so we'll just leave this thought with you, that the Scottish Fiscal Commission, in its budget forecasting prior to the budget release on the 19th of December, made a point of saying in that budget forecast that they've put a contingent liability in their report this time to account for a potential reduction in revenues of around 118 million due to what they think may result in behavioural responses. And this is the first time the Scottish Fiscal Commission have actually done that. And this is in spite of the fact that the outturn reports for 2024-25 won't become available until HMRC releases them in the summer of 2026-27. So the Scottish Fiscal Commission seem to believe now that there may be a behavioural response to the rates and bans in Scotland. So I'll just move onto the LBTT side of things. And the most important thing that came out of the budget in terms of LBTT was that there's a statutory Scottish statutory instrument that came into effect or it will come into effect actually, because it's only the 28th of March, not the 1st of April, but it comes in on the 1st of April, and it's to do with the additional dwelling supplement for transactions with an effective date of the 1st of April 2024 onwards. So the changes are not going to be respective, much to my disappointment and campaigning. They are not going to be retrospective, so there are no transitional provisions for the changes in either the ADS being applicable or the repayment conditions being met. So this means that any transaction with an effective date of up to and including the 31st of March 2024 will be subject to all the previous repayment conditions and timings, even if the repayment claim is made on or after the 1st of April 2024. So the most important headline coming from the LBTT ADS provisions as well as the sort of the repayment conditions situation is that the timeline's changing, which we're very, very pleased about because that brings it into line with the rest of the UK. And the change in timeline is from 18 months either side of the effective date of purchase to 36 months. So a buyer can now sell a previous main residence 36 months before or after the effective date, which is to be considered as them replacing a main residence for additional dwelling supplement purposes. So Revenue Scotland have produced a set of rather helpful slides actually, which relate to the timelines, also small shares, inherited dwellings, divorce and separation, joint buyers and provisions for local authorities to get relief. It's worth having a look at those slides. There's also, within the slide pack, there's a useful eligibility checker to see whether the transaction you're looking at is caught by the old rules or the new rules. So actually quite helpful of Revenue Scotland to put that out there. Scottish landfill tax, I've just put the rates there. They're the same as the rates in the rest of the UK. So Wales have also done something similar there. So I'll just move on to the next slide. So in terms of the Welsh budget, just a little bit of information for you on that. I've put a link to the Welsh budget publication in case you need to see it if you've got clients who are doing business in Wales. Income tax remained the same, so it's at plus 10% of the rate. It's a little bit like the old Scottish rate of income tax when they deducted 10% and then chose to add on any amount that they chose. So that's the same now in Wales. Wales doesn't have power over the bands, they just have power over the rates. So there were no real changes within the Welsh budget to land transaction tax, which is the Welsh equivalent of LBTT, or Welsh landfill tax, indeed. It's just increasing with RPI. And it's the same as Scotland and England as well. So essentially, that is the Welsh budget in a nutshell. Some new taxes on the horizon just to keep you updated about this. ICAS has been quite heavily involved in discussions and roundtables, and we've submitted consultation responses in respect of 2 prospective new fully devolved taxes, which we know now are going to be called Scottish Aggregates Levy, and also the Scottish Building Safety Levy, which has come about as a result of the cladding situation. So Scottish Aggregates Levy, you can read my article on the bill itself and watch the evidence session that ICAS attended from the 12th of March, sorry. And that is going to be a fully devolved national tax. And the permissions are all in place for that to go through. Scottish Building Safety Levy, it's proposed that it will be levied on non-domestic property, and it's being consulted on currently. There's a lot of discussion yet to be had about it. The intention is also, on behalf of the Treasury and the Scottish Government, that it is to be a fully devolved tax. In England, it is actually administered by local authorities. So we thought that it was going to be the same kind of situation in Scotland, but it isn't. It's going to be administered by Revenue Scotland. So it will be a national fully devolved tax. So the details of all of that have got to be ironed out at the moment. So we don't have too much detail on it at the current time. I'm going to be attending some more meetings on that soon as well. So the other interesting point that's coming out is the Green Freeports legislation. We know that sites have been awarded green freeport status in Cromarty Firth and in the Firth of Forth. So that should hopefully provide some economic boosts to those areas. And we know that there are going to be a few different reliefs available in terms of land and buildings transaction tax, non-domestic rates. There will be national insurance breaks for employees working in the tax zones, and also some elements of enhanced capital allowances. And the details are all being worked out on those things at the moment. I've put links to the Cromarty Firth and Firth of Forth websites because it's very interesting if you've got clients who are interested in investing in those areas, they want to employ people to work there, etc. It's good to get up to speed with those issues as soon as possible, and I will be publishing more information on those as we go. So I'm also just wanted to tell you that I am going to be writing the 2024 edition of the ICAS Guide to Scottish Taxes as well, which should be coming out within the next couple of months, hopefully. And also, in terms of Wales, it's worth looking at this because they're in the middle at the moment of doing a council tax reform programme. And the Scottish Government is very interested in how this is all panning out, how it's all working out. We had the Barclay Review in Scotland of non-domestic rates. There's not a lot of proposals on the table, as far as I can tell, to do very much else on the non-domestic rates front just now. But it'd be very interesting to see what happens with council tax over the next few years. So I just wanted to bring that to your attention. So I'll move on quickly now to the employment taxes update. The first point is about national insurance changes. So hopefully you've noticed that I've put a stamp on there because basically I'm old, and national insurance used to be called stamps, didn't it? So I thought I'd just put a little stamp on there. So so for employees, what we've got, Chris has already covered the self-employed stuff, but essentially we thought we were doing well actually after the autumn statement when we got 2% cuts in employees' national insurance from 12 to 10%, and because that actually works out about £450 of savings for an average person. And by the way, this is on earnings up to the upper earnings limit, which is the same as the high rate threshold. Over that, national insurance is still charged at 2%. So just because we've had a 2% drop in national insurance, don't think that it's reduced to zero over the upper earnings limit. And also then, while we thought we were doing really well, we did even better in the spring budget, because the national insurance was cut again by another 2% for employees to 8%. So the further saving on that, which is really good for people during this cost of living crisis, etc. So again, the 2% charge still applies if you're over the upper earnings limit. So I did want to say that national insurance is, just to remind you, it's a reserved matter. It's not devolved to Scotland. So Scotland has no control over the NI rates whatsoever. But interestingly, what we did see in the Scottish budget was, because there was some increases in tax rates for some of the bands. This may have been, and it's only a maybe, but it's my thinking that it could have been a reaction to the fact that national insurance was lowered by 2% in the autumn statement. So it gave the Scottish Government a little bit of leeway there with their own tax rates and bands. So I'm not trying to worry anybody, but we have had another 2% drop in national insurance. So in terms of personal taxes, income tax, we'll just have to see what the Scottish Government does in terms of a reaction to that in the coming tax year. So for employers, what I was going to say there was that it was slightly disappointing, actually, that employers who do need still so much help since the COVID pandemic, especially in certain sectors like hospitality, could do with a bit of a boost, probably. But unfortunately for them, the rates have remained the same. Employers' national insurance is still 13.8 across the board. And of course, that applies to not just payroll itself, but it also applies if you're paying a termination payment, and some of it is national insuranceable, expenses and benefits, Class 1A national insurance, Class 1B on pay-as-you-earn settlement agreements, etc. So that is that. And there also is not, and I think this has come around because of the increase in umbrella company fraud, which HMRC is working on very, very much, concentrating on that at the moment. The employment allowance is still £5,000. And it's still classified as state aid. So if your client is involved in state aid, then if they claim employment allowance, that needs to be deducted from the total amount that they're entitled to. So that's, I'll just move on quickly to double cab pickups. So I've put here an eventful week in the life of yours truly, because between the 12th and the 19th of February, in which I was away on holiday in Portugal with my husband, supposed to be celebrating Valentine's Day or something along those lines, I was bombarded while I was having my breakfast with telephone calls about what is going on with the double cab pickup situation. So I basically spent the rest of my holiday trying to sort it out. And thank goodness the agricultural and motor trade sectors stepped in and absolutely lambasted the government for bringing in new interpretations within their guidance. Please note that the legislation is no different to what it was before. There is no change at Section 155 of ITSA to the vans legislation. It's just that HMRC I think they've been waiting for an opportunity since the Coca-Cola case exploded a few years back to decide whether they were changing their interpretation of the double cab pickup truck to a car from a van. But actually, ministers had to step in, and within a week, everything had been reversed. So that was a bit of a success story, really, I suppose, apart from the fact that everybody had incurred an incredible amount of professional fees, lawyers, accountants, tax advisors, people were getting phone calls left, right and centre about this situation because of the expensive potential liabilities that they were going to face in terms of the loss of first year allowances, etc., and also a much heavier benefit in kind situation for employees and employers in terms of Class 1A, because as we all know, a double cab pickup is not a cheap vehicle. So thank goodness that happened. There was complete lack of consultation with the main forum, which liaises with HMRC, the Employment and Payroll Group. So I co-chair that on behalf of ICAS and the profession. So we wrote to the Financial Secretary to the Treasury about it, and there's a link to the letter in there, and there's also an article on it, so you can read that too. So I'll just move on quickly now to benefits in kind payrolling. Now, this has been announced as it's coming in, it's mandatory from April 2026. P11Ds, we're told, are to be abolished, and so there's going to be no more P11Ds, and all items of expenses, benefits in kind, etc., will have to be payrolled in future. So if you think about that, it's an absolutely massive undertaking to achieve within the next 2 years, or perhaps 450 or so working days. So there's an awful lot to think about here. Now, I'm not going to go into each of these items in detail because we don't have time today, but it isn't really necessary for me to go into it in detail, to be honest with you, at the moment. I've just set out some points to think about because none of the detail has been ironed out. And myself and the Employment Payroll Group are having monthly meetings with HMRC from now on for the next 24 months, just to try and make sure that we can make this thing work from the get-go. So there'll be a lot more information coming out from me over the next months and years about this until we actually reach the deadline. We're hoping that there is going to be a staged process rather than a sort of cliff edge where you just move from doing P11Ds into doing payrolling. There's a question over whether there's an overlap year in 26, 27, because as we know, benefits in kind are taxed retrospectively over the following tax year. So at the moment, we've got no information on how HMRC proposes to tackle this transition. So we'll just have to wait and see. So there's all sorts of different things, as you can see, to think about. At the moment, it's not possible to put loans and living accommodation through payroll because of the way the legislation is structured. So we're trying to get that changed at the moment. But as I say, I will update. There's a letter to the FST on the table. There's a link to that. So I'll just move on quickly. The changes to legislation and guidance, the proposed stuff is going to be coming out with all the rest of the taxation information through Finance Act, etc. So we'll see what happens with all of that. We need to look at penalties, and also one thing that interests me is what will the employer compliance activity look like after all of this is over and done with. So please read the information, and I think that's quite enough from me just now. Chris, I'm going to hand back over to you. Thank you.
Thank you very much, Justine. I'm just going to cover very briefly a couple of other areas. First one being making tax digital. Now, we are in a situation where the regulations for making tax digital have now been updated. So that confirms the April 2026 and April 2027 dates for self-employed taxpayers and landlords with income above £50,000 and £30,000 respectively. So that's now in the regulations. That's what we're working towards. ICAS has been seeking clarity on what's considered to be a digital record. I think there's a difference between VAT and self-assessment in terms of what their expectation might be. So it's something that we're having discussions with HMRC and will continue to do so over the coming months. Those of you who have had a time to look at the draft regulations will notice that we've now managed to secure a change in the quarterly update deadline. It was going to be the 5th of the month, but that's now going to become the 7th of the month to coincide with the VAT submission deadline for those businesses that are dealing with MTD for VAT and MTD for ITSA at the same time. You'll have seen some articles on icast.com about HMRC's pilot. The testing phase is moving from the existing pilot into what's known as private and public beta. Now, private beta is going to be starting on the 22nd of April, and it's likely that you'll have had an email from HMRC over the last few weeks, possibly as recently as this week, to give you the chance to register for private beta if the business meets certain criteria. Now, one of the things that was the main disadvantage of the existing pilot was it was only open to businesses which had a year end of the 5th of April. It's our understanding that when the new private beta comes in, that it'll be possible to test, apply to be involved in the pilot if you've got a 31st March year end as well. But more information is still to become published from HMRC. There are certain traits that a business might have that would make you ineligible to apply for public beta, but the expectation is that everyone should have the option to apply for public beta when that goes live in April 2025. The advice would be to consider signing up a handful of clients to test the readiness of your system and your client system, just to get used to how things might operate. You can do that in an environment which is really, really leading on penalties. So if you miss a quarterly update in the private beta phase, you're not going to be subjected to a penalty. It's only the annual return for that period. That came in the autumn statement. The important thing, of course, is to sign up clients using the HMRC's agent services account. And that, of course, does mean that the digital handshake is required to authorise that. And there's an article that's just about to go on icast.com, which is going to look at some of those things in more detail. Other topical issues, basis period reform. I've spoken about that a few times on previous webinars. So if you want to look at more of the details, please do go back onto icast.com and have a look at those webinars, which looks at the thorough, detailed announcements of basis period reform. HMRC has issued some guidance to unrepresented taxpayers. There's a webinar, as a video you can look at as well. You might find that useful as for additional support and guidance. One thing I would flag up is the online HMRC overlap relief information form. You can request overlap relief profits from HMRC. Now, that system has been up and running for a few months now. I'm told by HMRC that it's now operating very well and that requests are being turned out reasonably quickly. I would suggest, however, if you've got clients that you do not have their overlap profits for, I would recommend that you apply sooner rather than later, because I think the system may well get busier as we get closer to the 31st January deadline for doing tax returns. I have spoken to a few members who have let me know about some issues with the software for returns that are maybe being drafted or started with a view to some tax planning. I'm aware of some problems with some software providers, so if you have a challenge with that, it would be best to speak to your software provider just to make sure that overlap profits, for example, are being fully utilised. I've heard some cases of where that wasn't the case. Very, very brief mention of limited liability partnerships. This is a Companies House issue. I understand that some LLPs have applied to Companies House to have their year end extended to deal with the basis period reform requirements, or you have to change your year end, but it's easier potentially if you do. And apparently Companies House is not accepting basis period reform as a genuine reason to extend your year end. The advice is suggested to be that you go for a short accounting period instead. Once you're 31st March, 5th April going forward, then everything should fall into place. But just a little technical glitch when it comes to LLPs at Companies House. April's also seeing the launch of the cash basis as the default for the self-employed. That came out in the autumn statement, and there's been a big consultation at the start of 2023, and in response to that, it's been decided that the limit, that's £150,000 limit that's currently in place for using the cash basis, is going to go. And also there are previous restrictions on the deductibility of interest costs and the ability to relieve losses on using the cash basis. That's all going to go as well. That's all now in the legislation. So there's a new section in the ITOIA. So Schedule 10 Finance Act 2024 covers the changes. There's a new section 25B in ITOIA which sets out some existing trades, excluded trades, beg your pardon. If the business is not in an excluded trade, then the cash basis will apply as default going forward. But you can elect for the accruals basis to apply instead of the default cash basis. There's an election under section 25C of ITOIA 2005. Now that would remain in place until the election is revoked or the business operates an excluded trade. What I would say is that it's maybe worth, when thinking about basis period reform, other tax planning discussions with clients, to have a think about, would they want to keep in the accruals basis if they're already there, because it'll need to be an election made if that is the case. And lastly, from me, it's just to flag up the fact that the ICAS tax team is working hard on your behalf to do our best to improve HMRC services, provide feedback where things aren't working, also to provide feedback where things are working, because it is good to know when that is the case. We have regular forums. Justine mentioned a few of them earlier on that she's involved with, where we raise feedback, share feedback with HMRC and raise concerns that our members have. One thing I would say is that HMRC service levels are very, very commonly raised by members. HMRC is quite clear that they're seeing digital as a way around that, but what we would really like is if you've got any suggestions for any digital access or business that you would do with HMRC on behalf of your clients that would be easier done digitally rather than having to queue for long times of the day on the phone to HMRC. Please do let us know. Share your feedback with us. You can get in touch with us by email at icas.com. I will put a brief plug for our ICAS tax committee. We've got a few vacancies on a number of committees at the moment on the ICAS website. If that's something you might be interested in, please get in touch with us, even if to have an informal discussion. And last thing on there's one big problem in accounting at the moment when you're looking after your clients or running your tax practice, or even just in general on tax. Do get in touch with us. I'm really pleased and interested to hear about it.
Chris, thank you very much for that, and of course Justine as well. I think Justine will join us just in a second for some Q&As. We are obviously pretty well approaching 12 o'clock, which was when we said we would finish the webinar, but we do have a couple of questions that I probably want to get through, so we will fire on with those. Chris, probably start with you to start off with. A few questions coming in, I guess, in terms of the furnished holiday let position. And particularly, I guess, around lack of clarity on some of the things with that. There's obviously been the basic announcement in the budget, but then everything else falls down to the legislation. So I guess first question is, when do we expect to perhaps see the legislation?
It's a very, very good question, and I think a lot of it will have be impacted by the timing of the general election. I don't see any, I haven't heard of any date being released as to when we should expect that, David, at all. All we know is that the FHL changes are due to take place in April 2025. If there is a change of government before then, the timescale may well even change. I think, if I remember rightly, the last time there was a change of government, I think there was a change in a proposed update on the FHL rules. They've been with us a long time. They've actually almost nearly been with us as long as I've been alive. That's how long they've been in.
Excuse me.
Indigo.
So I suspect the answers to the questions around if we know what there are transitional arrangements around written down values on capital allowances, and where allowances couldn't be claimed due to due to delays in income generation through licensing. Letting licensing rules and such like. I suspect the answer to that is we need to wait until the legislation is published. Is that fair?
Yeah, absolutely. And those are the exact questions that we'll be seeking to get answers to from HMRC. And once we have any information, we'll be sharing it with our members on the. I'll certainly be at the top of my list for an article as soon as I get something in from HMRC. I mean, what I would expect there'd be some form of transitional adjustment, especially on the capital allowances front. But we just have to wait and see. I mean, I talked about companies as well. We don't know about the impact on those or going to be either.
Yeah, so that's great. Thank you for that, Justine. I think I've seen you answer this in the chat, but I'm just going to ask it for you in anyway. Couple of questions around employers at NIC, and I guess particularly also around the payrolling of the benefits in kind, and in terms of the agent access to the sign up for that. So I know you've covered it in the chat, but perhaps just for everyone watching that's not seen the chat, perhaps if you just want to cover that off.
Yeah, sure. Thanks, David. And yes, it's very, very disappointing that there's been no reductions in employers' NIC. I think businesses really need the help. We are definitely, and we have been lobbying for reductions. Hopefully, somebody will listen. Although, because we've got an election coming up, it strikes me that Jeremy Hunt's last statement at the spring budget was the last statement he's going to make until after the election, and possibly no decisions are going to be taken on anything else until after the next election. We don't know whether we'll have the same band of people in charge or not. So that's that. And the other thing was, David, what was it again? It was
just
about
in terms of payrolling benefits in kind and agents being able to sign up clients rather than the clients themselves.
Yeah,
having to do that.
definitely.
Yeah.
It's a major problem. We are asking for that to happen. I'm actually compiling a massive spreadsheet at the moment of all the issues that we have with payrolling benefits. So we've already got probably about 150 different items to discuss with HMRC, and the list will grow before it reduces.
Yeah, that's great, Chris. Couple final questions. I think for you. There's a question came in around capital gains tax, or in particular around capital losses, and how long you can carry forward capital losses for.
The losses just get carried forward indefinitely.
Yep, that's great. Thank you. And the another question was around the annual investment allowance on finance lease assets. Can you claim the AIA on finance lease assets if you can't on full expensing?
Finance lease assets is probably something we could almost do a webinar in itself, possibly on. What I would say is, the first thing I would say in response to that is to make sure, is the fixed asset addition actually definitely on a finance lease? Sometimes people get confused between finance leases and hire purchase, because if it's hire purchase, then you're able to claim capital allowances once that asset's been brought into use for the business. If it's finance lease, then the general rule is that you would not normally be able to claim capital allowances, but you might be able to have a deduction for the accounting depreciation. But the rules on leases in general are quite complicated, so probably that's as far as I could go within the time we've got to talk about that just now.
Yeah, that's fine. And I think there's also a couple of other questions come in, or comments come in really around trying to get overlap profit requests from HMRC, and there seems to be some delays in relation to that, and also I think an issue in relation to online partnership registrations and partnership registration forms, both of those which we will take away and take those up with HMRC to find out if there's something in the background as to causing those delays, unless either Chris or Justine are able to just very quickly answer that one or know of anything around those.
Happy to speak about the overlap profit one. I mean, the G form that's on there, HMRC is supposed to be turning that around very within a reasonable time scale. So if that's not happening, please do get in touch. You can email the tax team, tax@icas.com. Very pleased to follow up with anyone who's got challenges, because we've got direct contact with the team that set up the form, and they've updated the form to take account of feedback from ICAS and other professional bodies too.
Yeah, so that's great. Well, as I say, we have ran over. We've gone over the 5 minutes. Thank you for everyone that has stayed on. I can see the attendee numbers holding up well. But as I say, I think we will have to draw things to a close at this moment. Chris, Justine, thanks very much again for joining us. It's such a comprehensive coverage of the latest developments in terms of OMB, devolved taxes and employment taxes. If we have missed any of the questions, we will just compile a document and put those online alongside the slides. So do please, of course, remember that you can keep up to date with all the latest tax and other professional news, including the latest information guides and resources on icas.com. And of course, you can access any technical support. Any of the further questions that you have can be in relation to tax can come through the technical help desk, available through the contact us section of the website. It would be great if you could leave us a rating for today's webinar. There's going to be a poll which will appear either on your screens or in the chat box, depending upon the version of Teams that you're working on. So we do really appreciate your feedback. So do please just take a moment to respond to that before you log off. Looking slightly further ahead, we do, of course, have a range of webinars in the weeks ahead, which you might want to sign up. Just a couple of those that I want to highlight to you. On the 18th of April will be part 2 of our Spring Tax Update, when I'll be back alongside Susan Cattell, the ICAS Head of Tax Technical Policy, looking at some of the general taxes, tax administration and other policy areas. So do join us again for that. And also on the 5th of June, an in-person event. Do please join us in Edinburgh for the ICAS Practice Conference, where we will be looking at the topic of navigating the future, where we will bring together a range of expert speakers to explore the challenges facing the accountancy practices and how to overcome them. This year's conference, we're going to delve deeper into the challenges from attracting and retaining staff, keeping up with the latest technology, and offer practical strategies to navigate the evolving landscape. So with a focus on practical guidance and success stories, the speakers, and it's an amazing lineup of speakers that we have lined up, they will share their insights on staying agile in the face of uncertainty and hopefully leave you inspired and ready to take action. This conference is, of course, exclusively for members in practice, and it will include expert-led sessions and round tables with ample opportunity for you to network with fellow members in a collaborative and friendly environment. So do please sign up to all those events. They're available to be done at icas.com/events. It only leaves me to once again thank Chris and Justine, and of course you, the audience, for joining us today. I see lots of comments about how useful it's been, so thank you very much for those comments. And until the next time, thank you for joining us, and goodbye.